Well, the April growth data from China was shockingly slow. Industrial output contracted by 5.7% from March levels, while retail sales contracted by 0.1%, again from month-ago levels. Real estate was a big drag, but it wasn't the only one. And this has led some brokerages like JP Morgan to cut China's GDP growth for the second quarter and for the full year. Now, anything positive or anything negative for China can impact the rest of Asia, but it could be positive for India, which is not terribly dependent on the Chinese supply systems. To assess the impact of China's slowdown problem, and its impact on Asia and India, I'm joined by Jahangir Aziz, the EM economist from JP Morgan, and Fook Hein Yap, the senior investment strategist at Standard Chartered. Fook, I hope I got your name right. With your permission, let me start with Jahangir because he's waiting for us all the way from New York. He has stayed up. Thank you very much, Jahangir, for staying up. But I know I called you for China, but just before I get to China, can you tell us, the impact of this personal consumption expenditure? The inflation is higher in those numbers than expected in the US, and the debt ceiling is mostly off now. So, what does all this mean, according to your team, to what we should expect from the Fed?
So clearly the data has been, especially on the final demand side, has been much stronger. And that is also not just reflected in the private consumption numbers, but in the core inflation numbers. The economy is slowing, but clearly it's not slowing as fast as would give comfort to the policymakers that things are going in the right direction. And clearly that's a risk. Even if you look at the non-farm payroll numbers, the non-farm payrolls number should by now, if we were truly looking at a slowdown, should by now be below 100, and it clearly isn't. So I think while we still continue to believe that by the fourth quarter, the US economy will slow into a mild recession, the data flow clearly is being stubbornly moving in the other direction. There was obviously the concern, along with the banking sector stress, about the debt ceiling. And if the debt ceiling is truly out of the way, then I think the market is likely going to think that the June rate hike is not completely out of the question. We have about a third probability for a June rate hike, but our baseline is that they will pause, and they will pause for a prolonged period of time. I think the real gap between our view and that of the market is that we don't really see any rate cuts in 2023. The first rate cut, if it happens, is going to be in 24, whereas the market has a significant amount of rate cut already priced in the front end of the curve by the end of the year. I think that's where the big difference is. It isn't so much whether June will be a skip or June will be the beginning of a pause. But it's really towards the end of the year.
Okay. All right. We've got some idea of that scare. Now let me come to China, which is quite clearly becoming an important talking point for strategists as well as economists. JP Morgan itself stunned the market by cutting China's growth by 0.5 percentage point from, 6.4, I think it'll have come down to 5.9. How bad is the China slowdown?
So I think that, China has always been the story of, exuberance and extreme exuberance on one side and extreme disappointment on the other side. And I think a lot of how we think about China is based on memories of China doing incredible things on the growth front. I think that China hasn't been the case for a long period of time. It's nothing to do with the pandemic. So when the reopening was announced, the reopening was, everything, everywhere, all at once reopening. And that created this exuberance that China would be growing, and not just growing, but growing across every sector, across the board. In the first quarter, we did see a very, very strong China growth number. We had 12% quarter on quarter. But, the assumption was that this is going to spread to private consumption. This is going to spread from private consumption infrastructure. Is going to spread to private investment, the housing market, etc. Reality is never that way. And I think that any recovery will have hiccups. So the April disappointment with the numbers, I think contains both noise and signal. And I think what we are doing is we are basically going back to our China forecast that we had in January, and we're sort of tamping down on the exuberance in March. So we do still expect China to deliver about 7% average growth rate in the first half of the year, 5 in the second half of the year. Again, that's because of the lack because of the front loading of policy support. So 6 on average. I think with China, you will see this pendulum shift between this extreme exuberance and disappointment as data flow comes. I can guarantee you if the next data point is moving upwards, everybody will rush to raise their forecast on China.
Oh, really? It's like that, is it? Fook Hein Yap, thank you for your patience. What's your assessment with the, even the April import numbers were terrible, indicating perhaps a slowdown. So are you all shying away from China in terms of weights given for buying? What's your assessment?
Yeah, thanks very much. A very good morning to you. I think we are looking at the data. We're seeing the positive economic surprises that come off the high. So it's off the peak. I think we had a very strong start to the year. The reopening happened sooner than expected. And there was a lot of expectation that will be a huge boom. But I think the data or expectations got a bit ahead, perhaps. So we're seeing the data coming in still, sequentially, we think it's still okay and it's still showing signs of improvement. And with the spring holiday break, we saw the spending was already back above pre-pandemic levels. And that should come out when we see the May data come out. But in terms of the economic surprises, as you alluded to, it has come off. It's off its highs. So that is something that the market is digesting and putting behind us. But looking out for the next 12 months, we do expect China to be the driver for global growth, especially relative to the US and in Europe as well.
Oh, really? Okay, so you're not at all dissuaded by the recent Chinese data, should I say. What is your pecking order in emerging markets? Is it still China first? Where does India figure?
Yeah, it's a good question. On the back of the data being a bit softer, we just downgraded China to be neutral within Asia ex-Japan. So India is neutral as well within Asia ex-Japan. But to be clear, we prefer Asia relative to other areas globally. So it is still the area that we like. We still see policies in China is going to be very targeted. Now they want to improve consumption. They want to have a targeted support for certain industries. We think they will support the property market as well. So we think growth there is still going to be stable, but we do have a neutral view within Asia, Japan, just like India as well, it's a neutral view. But the whole region is something that we still like, given that we see a growth there better compared to your other developed markets.
Okay. Well, same question to you, Jahangir. My sense was that if China weakens, ASEAN countries are more linked to it, but India is not. So does this complex, in your analysis, make India a more shining story?
I think a lot has been written, a lot has been talked about this idea of relocation out of China. I think if you look at the hard data is nothing close to that. So if you look at Chinese, FDI, for example, Chinese FDI, if you take the 22 and 23 average, it's running around $300 odd billion. If you look at India's FDI data, which was running probably around 45 billion dollars, has actually over the last 6 to 9 months halved to that pace.
Yes.
If you look at what is happening in Vietnam, right? You did see a significant increase in FDI long time back, and that's continuing. For Vietnam, these are very large numbers. It will make Vietnam's growth, double and triple. Export growth double and triple. But these are very, very small numbers compared to the size of FDI that goes into China and the continued FDI that is going in. For example, China releases a series which is called FDI utilization. So this is not just FDI that's come in and sitting in bank accounts, but it's FDI that has actually hit the ground. Last year, it was $189 billion, the highest ever China has seen.
Okay. No, I get that point. I'm sorry. Actually, we're running out of time, Jahangir. let me get Fook in on another aspect. You know, if the Chinese growth is not as strong as earlier anticipated, or at least it disappointed in April, and if that were to continue as Jahangir expects in this quarter, then Fook, would you expect commodity prices to remain subdued? Because their import data is also pretty bad. And if that is the case, then that's positive for India as a commodity importer. Your thoughts, Fook?
Yeah, I mean, we do look at the crude oil, specifically the WTI. We see it coming down to about 69 in the next 3 months. So, dipping below the 70 level, and then over the next 12 months, coming down to about $65. On the supply side, we recognize there's a lot of discipline in there from the suppliers and OPEC Plus as well. But on the demand side, that's just really where the worry is in terms of the demand, especially if the US goes into recession as we expect, it would affect the demand side of things. And then in China, that is still a bright part of it. But yes, I think overall our market, our view for the WTI is about $65 for the next 12 months.
Okay, no, but doesn't that push up India's attractiveness, because it's a huge crude importer and a commodities importer?
We do like India's market. Like I said, we like the whole region of Asia. We think India can outperform globally. And the issue has always been the valuation with India. It's close to 50% premium. And it's always had a premium, but we see it coming off the peak. The growth is strong, but we think it is priced in terms of the valuation for the equity market. So that's what I'm referring to equity market.
Okay, I get that. Jahangir, a similar question to you. Do you see commodity prices, does your team see commodity prices dipping because China is consuming less? If I remember right, you all are still bullish on crude.
So we are forecasting softer commodity prices for sure, but there are two differences. One is energy versus non-energy. I think in the case of energy, we consider this current slump in energy prices largely a reflection of fears of a near-term US recession. And as I said, as the data points are basically showing that fear is probably over-exaggerated, I think we do see a recovery taking place in energy prices maybe for the second half of the year. So we still have $85, $90 a barrel towards the end of the year. I think on the other part of the commodity, the thing, if you separate out rare earths and look at materials, industrial materials, yes, there is a significant slowing in industrial material prices, largely because the world is becoming commodity light. It has nothing really to do with just China. It has to do with China and everybody else trying to become commodity light, and that's showing up in the prices. I think it's rare earths is where I think China will play a critical role, because that's where much of the infrastructure will be requiring. So I think rare earths, materials, and energy, all three of them are being now driven by three different dynamics, and it's not just high growth and low global growth, as it used to be the case in the past. I think people have to do the hard work. We're looking at individual commodities and figure out what the prices are going to be.
All right. Okay, so this is more complex than I thought in terms of understanding. Thank you very much, Jahangir and Fook, for enhancing our understanding of the China and related ecosystem. So Chinese growth, extremely eccentric and idiosyncratic, as Jahangir says. You may slow down now, but people may revise rates higher. And Fook is anyway, Stanchart is anyway very positive on Chinese growth. India, the problem is valuations. And as Jahangir says, not necessarily a beneficiary of investments moving out of China. On that note, we wrap up on Bazaar. The market, of course, is in very fine fettle, not worried about these ecosystem concerns at this point in time. Chartbusters will take the action forward.